Why is brand building important?
You want to know what it will take for this business to break even.
Need plus action equals value.
You sure? Understand the market that you are operating in.
How do you make sure that you are successful?
And what happens should you preach?
What one thing could we improve?
Start with why.
Come.
Come.
Journey with us.
My name is Gideon Amakali, and I'm Head of Management Accounting at Bank Windhoek. In Management Account at Bank Windhoek, this is what we call financial planning and analytics of the bank, where we look at the finances of the bank, the financial numbers, and giving insights to the bank users. Understanding basic financial terms is crucial for any business success. Looking at the performance of a business, there are certain key metrics. The first one is revenue, followed by OPEX, operating expenses, followed by profit, the residual thereof, and the cash flow in the business. What is revenue? Revenue is the total income generated from the selling of goods or services. To give a practical example, if you are involved in selling of sweets at a tuck shop located somewhere in the location, for example, Singa Quarters, the selling of sweets daily to the kids in and out, the proceeds you receive from the kids, the customers, that is your revenue for the said transaction. The operating expenses is the costs involved in rendering the such sale of sweets. The cost of buying the sweets from the shops, basically from Choppies, for example, or ShopRite. How much it costed you to buy from your supplier of sweets. That is the cost of the said transaction. The next metric is profits. Profit sums up the performance of the said transaction or the said business operations. In an event where your collected revenue is more than the cost of the sweets, then you are in a profit-making position. If your revenue is less than how much it costs you to buy that pack of sweets from the shop, then you are in a loss-making position. The last metric is cash flow management. Cash flow is the movement of money in and out of your business, essentially maintaining liquidity or anything else. So what is budgeting and forecasting? Are they not the same thing? So plainly put, budgeting is the plan of the future, how you are going to spend your money and how you are going to generate your money. Whilst forecasting is the prediction of the future, budgeting assists you in keeping you accountable as a business owner. It actually answers what you need to focus on to get your targets in place or to achieve the set plans for your business performance. I want to start a business, but I don't have capital. How should I go on about it? There are various options one can take. That is the good news. The first option is usually the easy one, using your own funds. The benefit of bootstrapping is you retain full control of your business. There's no need to dilute ownership. The only key disadvantage you have is limitation in terms of scalability or growth. If you do not have as much capital as you need, you actually not gonna grow in the long run. So the second option one have is what we call angel investors. Sounds very angelic, yes. Individuals usually who provide capital in exchange for equity. These are usually high value, well-versed and specialized individuals where you get to leverage on their expertise, if I might say. If they inject some capital into your business, then you need to give a share of your business to these investors. Being able to leverage on their valuable advice or a well-experienced and well-versed expertise. The only key downside being dilution of ownership of your business and potential loss of control over some key business decisions. The next one is venture capital. When firms invest larger sum of fund into your business, usually for high growth potential businesses. In return, they would either ask for equity or they would actually ask for higher returns from your business. The last one, most probably the most famous one, is business loans from financial institutions. Obtaining a business loan is when you approach a certain financial institution or a certain bank, in this case like Bank Windhoek, and you request or you apply for financial loan, basically. It can be long-term or short-term. A business loan from a commercial bank is usually granted at a set rate with a set payment term with set requirements, if I must say. That gives you predictability of when certain cash flows or certain obligations needs to be met for these loans. It's almost so defined at the beginning. Unlike the other previous 2 points, you get to retain full ownership as is of your business. So the downside of a business loan, interest payments or interest rates can be quite high and can become unaffordable or unfavorable at a point in time. The requirements in terms of collateral or security of this said loan can be quite challenging for an upcoming business or rather a not well-established business. Cash flow statements or cash flow management for a business operation. Am I making money? How good am I at managing my money within my business? There are certain qualitative aspects which should be covered by a cash flow statement or a cash flow forecast. Accuracy and realism. It should be correct and it should reflect close to the truth. Basically, it must be real. It should be transparent and detailed. It must answer all the unasked questions, if I must put it. Overly optimistic forecasts can sometimes be red flags in assessments of either funding applications and others. Liquidity management. How well are you managing your cash flow? How well are you managing your money? And remember, cash flow talks to the movement of money in and out of the business. And the last but not least, of course, it's growth projections, growth forecast. It must clearly demonstrate how growth is going to come and where growth is going to come from. So starting off with liquidity ratios. This ratio actually primarily just indicates how well are you managing your cash flow, mostly short-term or long-term if the period of the loan is that long. So let's start off with the short-term obligations indicators, those ratios. The first ratio is what we call a current ratio. It indicates actually the ability of you meeting your short-term obligation. By short-term, I mean in the next 12 months, if you get a set loan from a bank, for example, how able are you to cover your obligations in the next 12 months? These we look at all your dues which are due in the next 12 months and all your collectibles, basically your receivables which are due in the next 12 months. Then we express them as a ratio. If that ratio is above 100%, that is actually regarded as a minimum safe levels. The higher it is, the more safer your projections are. The investors usually would want also to look at stress scenarios or stress ratios in terms of liquidity. So the second ratios the financial or the investors actually would look at is your quick ratio. This is what we call your acid test ratio. Yes, acid test ratio. So it's almost a stressed scenario. So it indicates the ability of you meeting your short-term, your 12 months obligations without realizing your inventory. They take your current assets, your current receivables, any assets which are most likely to be realized in the next 12 months, and they exclude inventory. And then this is then expressed as a percentage of what is due in the next 12 months. This is current liabilities. And then if your ratio is still above 1, then this is actually an indicator of a good cash flow projections. Anything below 1, it indicates potential struggles in the future of you meeting your short-term obligations of this said loan. And this is usually highlighted as a red flag. Profitability ratios. There are two key profitability ratios which must be answered. First one is what we call your gross profit margins or your gross profit indicators, basically. So how profitable are you just by taking your directly linked costs as a percentage of your derived revenue? You take all the revenues collected from your customers, and then you actually deduct your cost of these sweets, basically. How much it costed you to buy these sweets from Choppies. And then you express the residual or the rather gross profit as a percentage of revenue. This indicates the gross profit margin, or what we would call GP margin. Any positive gross profit margin is regarded as good, but the higher it is, the more lucrative or the more positive cash flow forecast and projection it indicates. The last one is your net profit margins. So you've taken all your revenue collected, and then you've deducted the directly linked costs, basically the said cost of buying such sweets from Choppies or ShopRite, and then there are other overheads, of course. Rent you pay for your tuck shop at that specific place. The water and electricity thereof, the salaries you pay, all of those costs, basically you need to sum them up and then deduct them from the gross profit. That gives you the net. So it's the net of all any other costs. The higher the percentage ratio, then the good indicator of your potential cash flow projections, basically. And without saying, if this said ratio is negative, it's an early indicator, or what we would call it a red flag, that your cash flow is most likely to face challenges down the line, basically. Debt to equity ratio. So this, in a nutshell, measures the proportionate of debt to equity within your operations, so within your business operation. By that, it means, actually shows of your operations, how much of it is covered or is actually funded through debt. The less reliance to debt you have, then the lesser your ratio would indicate. And usually this is a positive indicator up to an extent. It determines the gearing and the ungearing of your business operations. If you are highly geared, basically that means you are funded massively through debt, can come out as a red flag at a point. The lesser the ratio, usually the best it is, basically. The second sub-ratio under leverage ratios is your interest coverage ratio. So this assess your ability to pay the interest on an outstanding debt. As an investor, or if a financial institution, for example, would actually be interested in the ability of a certain business operation to service the debt. You can have a healthy balance sheet, high assets on the balance sheet. That means you have high numbers on your balance sheet and in assets. But if your interest coverage ratio, so the ability to cover and service the loan, is lower, then this comes out as a very big red flag in your cash flow forecast and in your financial statement analysis by that said financial institution. The last ratios would actually an investor look at is your efficiency ratios. So we're gonna cover two ratios under here. First one, inventory turnover ratio and your debtors turnover ratio. Those are two. So explanation is in the word turnover. Inventory turnover, it actually assesses the pace where you are turning your inventory into cash or into a sale, if I must put it plainly. You must always assess your inventory turnover ratio and look for ways where you can actually turn your inventory into a sale faster. And then leading to the next ratio, the next assessment, the next indicator is your accounts receivable turnover ratio. How fast are you collecting from your debtors? This is measured in days. The higher the days, it just indicates you are taking longer to collect money from your debtors. And to my previous point, you need money for a better cash flow management and also for you to be able to do interest coverage, basically. So you need to collect funds from your customers. The lower this rate is, then the better and the best it must actually look at all times. Thank you for joining us for this episode. Catch us next time for more expert advice to help elevate your business. Come journey with us.